Let's talk money.
Hello and welcome to the latest edition of Let's Talk Money, your personal finance date with me, Surabhi Upadhyay. Now, this is our fourth episode and we've decided to focus on one specific issue and one specific set of investors today. I'm talking about all the youngsters out there. I remember that I started my investing journey when I got my first paycheck. That's when the whole concept of equities dawned upon me. Well, since then, a lot has changed. There are a lot more financial products out there, but there's also a lot of noise. There's more confusion. So how should all of you young people out there start your investment plan? What are the do's, the don'ts, and what are the kind of numbers you should keep in mind to start harnessing the power of compounding? That's what we're going to talk about today. And my guest on the show is Rahul Jain, who is the president and head of Nuvama Wealth. Rahul, it's great to have you in our studio. So come on in. Brilliant that you can join us over here because you have a very, very interesting topic at hand.
Thank you, Surabhi. And I think topic is very interesting. And thanks for inviting me to the show.
Yeah, absolutely. You know, I know that you deal with, obviously, I'm guessing, a lot of adults, a lot of mid-career professionals who are, looking at wealth in a different perspective. But I'm just curious, do the younger family members have any sort of a role? I mean, what's the youngest sort of client, perhaps, that you would have had, some interaction with in the recent past?
So I keep interacting with a lot of genres of client. And I would say that in 15 days back, only I was talking to a 20-year-old individual.
A 20-year-old
individual, and he was chatting about investments. And I said one of the things that since you're talking about investment at a certain early stage, I think one of the biggest benefits which you'll have is that in investments or personal finance, compounding is a very important role.
Yeah.
And you need time for that. Since that individual at 20 years has a lot of time, I think he can really have that power of compounding coming in.
Yeah.
To just give you some perspective, a 12 of money which compounds at 12% in 40 years becomes around 100x.
In 40 years?
40 years, if it compounds at 12.
Okay.
Now, if it compounds at 15%, this becomes 270x. So a lakh can become a 90 lakh or 3 crores. So that is how the number changes. And I would say that someone who is starting very young, he can take a lot of risk, learn from mistakes, also have virtues of a successful investor like being patient, think long term, be disciplined. Generally, when you become 50, then those conversations become very difficult.
But it cuts both ways, because I can tell you, I'm just going back and thinking about, again, way back in the day when I started getting enough of a salary to think. And the incentive at that point, frankly, wasn't compounding or long-term wealth creation. It was just income tax, right? I think for a lot of us, it was, okay, we need to save tax, so let's park some money. And equity, mutual funds, the LSS category used to be a good place to go with. But now, since then, so much has changed. Now the markets are more complex. And now we're seeing youngsters, as you're saying, take on more risk. There's a propensity to go direct in the market, to trade, to do a lot more. What do you say to that?
So I agree. I think the options have really gone up in terms of things what you can invest. For example, now you have mutual fund, you have SIPs. A lot of young adults or kids do trading in options and futures. Crypto was also one time a big thing.
Oh, yes, yes.
Correct. There was a very large number of investors from India on crypto, and largely young people.
Isn't that scary? I mean,
it's very scary, and that's why I keep telling everyone that one of the things which I say that don't trade in options and futures. It's risky. Start as an investor. Think long term. Be patient. That's a very important virtue, and you can learn it right now. And you can have the real benefit of compounding. So you have the real benefit of compounding, then there is no need of doing something which can make you fast bucks. And that's why having patience, thinking long term, diversified, being an investor are critical. Very important.
I think it's one thing to be cool in your peer group. It's another thing to be wise and make lots of money by the time you're like 40, 45 or 50. Okay, Rahul, so with your permission, I'll straight away start with the questions. And we actually have a young person who's going to be joining us live on the show as well. So quickly getting to it. Our first caller today our first viewer is Praneeth. I think he's from Andhra Pradesh. Praneeth, welcome to the show. Thank you for joining us on Let's Talk Money. Tell us, how can we help you?
I'm Pranit. I'm 26-year-old. I live in Andhra Pradesh in a district called Kurnool from Adoni town. I do work as a registered valuer in all the nationalized banks right now. I'm 26-year-old, so I need to know how to start investing. What are the basic things about investing, with the knowledge which we should possess to start investing.
Okay, you're 26 and you want to be on the investing path. That's great. But help us with some more details here. I mean, I don't know what's the kind of income, what's your salary level, what is the kind of disposable income that you perhaps have, money that you have at hand that you're looking to invest, and have you made up your mind? Do you want to be in fixed income? Are you willing to look at equities?
I earn around 80,000 per month right now. I can invest around 25,000 to 20 to 25,000.
Okay, that's good to know. So currently, have you started that investment anywhere? Do you have any mutual funds? But where are you parking this excess money every month now?
I have invested in fixed deposits.
Oh, okay. You're only looking at FDs. I must ask you, because for a planner, for Rahul to come up and give you advice, we also need to understand whether you have any goals in mind. You know, there could be long-term goals, or maybe something simple like you want to buy a car or a bike. Maybe you want to buy a house 10 years down the line. Anything in mind for which you'll require money?
Car. It is car within 4 years from now.
Car. Okay, you want to buy a car in 4 years. But Rahul, that's great, right? He's still willing to be patient. Today, it's buy now, pay later. Otherwise, it's like I'm buying now, I'll deal with the EMI later. But he wants to invest properly, and in the next 4 years, he wants to buy a car.
Correct.
What would you say?
So I would say multiple things for Praneeth. I think since he's starting his investment journey right now, I'm happy that he started thinking at the age of 27.
Yeah.
He has a lot of time for that, the money to compound in. But I think the first step for him is to get his asset allocation right. I think that's the philosophy of building a portfolio. Asset allocation is simple, have the combination between equity, debt and some gold.
Okay.
The basic thumb rule on asset allocation is that 100 minus your age should be an equity portfolio.
100 minus your age.
Okay. So for Praneeth, 100 minus 27 is 73. So he can have a 75% equity portfolio.
Okay.
5% can be gold because gold is a good hedge. When nothing works, then gold works. It's a very important part of the portfolio. So 75 in equity, 5 in gold, 20 becomes debt effectively. And I think that's a good asset allocation model for him to work upon in that sense. Since he has a lot of age by his side, he's 27, I would say that he can go through a SIP route. He makes 80,000 rupees and he says he can invest 25,000. I think that's a good combination. 30% of income can be invested, should be invested, I would say. So 25,000 rupees, effectively 18,000 going in equity SIP, 5,000 going in gold, and balance going in the debt side would be a good combination. What he can do is that while he builds this out, he can compound this at 12% effectively.
Sure.
And that can become a sizable corpus. When he needs a car, he can just take out that money out of it effectively. The thinking is making it complex, that should I make it for a different goal altogether?
Correct.
I would suggest that let it run and let it compound.
Okay.
There are a lot of chances that people change their goals also.
That's true.
And that becomes complicated. Then having different investment for different goals becomes complex. What we generally suggest that make your core investment
like a common pot.
And when the time comes, just withdraw that out.
Fair enough. Fair enough.
So that can be a good way of him managing it out. And but he should follow asset allocation.
Yeah.
I think Praneeth is starting very early. I would say that be long term in your thinking, be patient, and don't try overbooking your profits very fast. I think just keep it continue growing, and that is essential.
You know, if you think Praneeth is starting early, wait till you hear the next set of queries, because I have 2 students and they've written in to us. Both are, these young ladies. One is, her name is Mitali, and she's sent this question saying she's studying for her master's degree in Singapore and she wants to start building up her investment portfolio. And she's saying, since I'm studying, it's very natural, right? She can't actively track this portfolio, can't give too much time. But can there be a strategy that helps me at least start? And I'm clubbing this with another question. This is Sachi. Again, she's a student and she's saying that she's pursuing a master's as well. And she's saying that how to start that journey and how to avoid a lot of the common pitfalls that people perhaps make along their investment journey. So they're young, they're students, they can't spend too much time doing research. Where should they begin?
So I would like to start congratulating them first, because at such a young age, they're thinking of investing. I think it makes a lot of sense. I think, as I was saying earlier also, starting at 20, you have 40 years of compounding. Actually, if you do right compounding, you can make your money going 250x. I think that's a mind-boggling number according to me. I would suggest that starting early. I think they should use some sort of asset allocation as a philosophy.
Sure.
But large part of money should go into equities.
Because they're so young. They're
So young,
students, yeah.
So they should go into equities. It's very simple for them. Since I'm sure that both of them would be busy in terms of their education, classes, etc. They might not have time. I think the best thing for them is to go for a ETF, equity Nifty 50 ETF, I think, which is very simple to track. They don't need to track it on daily basis. They can do it once in a month, once in a week types is easily trackable effectively. And it's very, I would say, very cost efficient also, because it is largely in a ETF format where the charges are very minimal. So that will work well for them. And I'm sure that they will keep adding to the corpus. That can become significant over a period of time.
But basically passive funds, ETFs, index funds, great starting point for someone who's just beginning. Okay, fantastic. I wish I had known this. I would have done things differently.
Same for myself. You're not doing different. I think when I started my career, I did a real estate investment. And now the times are changing, that kids are coming and asking for a equity investment. For
an equity strategy at 24, 25, right?
So whole thing altogether.
That's a new environment, new era that we're in. Okay, on that positive note, we're going to take a very quick break. More questions answered. All of those queries coming in from young adults on their investment portfolios. We keep it with this conversation on the other side.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we're talking about how all of those young adults out there should start thinking about their investment portfolio and their investment journey. It's never too early to start. So, Rahul, I've got another question coming in. And by the way, girls are really active. A lot of women investors and young girls, they've been writing in. This is Madhuri. She's 27 and she's saying that she wants to start thinking of a retirement corpus already, which is phenomenal.
Wow.
And she's saying that she also wants to be able to support her parents because they're already retired and may be in need of some funds. So how should she go about doing this? Maybe we can create a model portfolio or some kind of an example for her.
Yeah, we can do that. And I would say that if she's thinking of retirement 27, I can tell her that it's very much possible. It can be a sizable corpus which she can create by the age of 60 and all. That is what I think about it. But I think we have spoken about asset allocation, correct? And we also spoken about compounding. Let me give you an example and how we can illustrate that. Let's take an example that she wants to save 25,000 rupees on monthly basis. And effectively how we look at it is that the 72-73% goes on equities, seeing her age, which as per 100 minus the age is the equity, which will be around I would say 18,000 rupees, which goes into equity SIP.
Now, this sounds a lot, Madhuri, but if you're listening to us, this is a hypothetical situation, but it's an example to tell you what can happen if you start investing these sums. Say if you manage to save 25,000 rupees every month, and then the breakup. So please continue. What's the breakup like?
18,000 is equity SIP, 5,000 is debt, which is 20% of the portfolio.
Sure.
And then 2,000 goes to gold at 8% of that portfolio.
Okay.
Now, if you think that the equity grows by 12%.
Fair enough assumption,
I think,
correct, for equity. Yeah.
And gold and the fixed debt part goes by 7%. That is also a very conservative assumption.
Okay.
So if you see what she can create is in 10 years, she can actually accumulate invested amount of around 48 lakhs, which will become 77 lakhs because of the growth in 10 years.
48 lakhs of investment grows into a corpus of 77 lakhs in 10 years.
10 years.
In 20 years?
20 years, this amount will become from 1.7 crores to around 4.2 crores.
Phenomenal.
Yeah.
20 years of patient investing.
Yeah. And now see 30 years. That is the most interesting one, which says you accumulate on 5 crore rupees and that actually becomes 17 crores of the value of money you have.
So by the time Madhuri is age 57, looking at retirement, if she's invested in this manner, 5 crores will become 17 crores.
That's true. That's true.
That's the power of compounding.
That's the power of compounding, and that is the point which comes in, which says that start early, you'll be able to compound. Be long term, be patient, don't change your allocations too much, don't book the profits and keep on the losing streak of the portfolio. I think these are common things which happen. I think a successful investor is always patient, thinking long term, and is diversified. And I think by using asset allocation and keeping patience, using SIP as a mode, you are able to balance that out completely. And you will also see that how a 17 crore corpus can come out of a 25,000 rupees SIP with just a step of 10% annually. That's a easy one.
That happens if you start at 27, when you are thinking on those lines at 27. So it's really important to be on the right track.
I think discipline is very key, Surabhi, and thinking long term is very key. You can make serious amount of money.
Oh, absolutely phenomenal. Okay, we have time for I think one more question. This is Dhruvi. Now Dhruvi is saying she is in her final year of undergraduation. And she wants to know how a fresher like her can start on the whole investment sort of journey. And she's saying, what are the things to keep in mind before I look at building a portfolio? And she also is talking about losses. Imagine, so early on, she's saying, how should I deal with losses if I start incurring losses on the investments that I make?
So I think, again, I think I'm getting awed by these youngsters coming and talking about losses and investments such early stage, final year of college. So I would say that again, start with asset allocation. Since you have a lot of age by your side, I think the large part of investment should be equities. She can use the SIP route where she can keep accumulating money and that can become big corpus. And obviously now she'll get graduated, then she will get her first job. The money will, the flow of the money will go up, the income will go up. She can step up the SIPs and keep focus on that. I think that can become a sizable corpus. The thing at her age, I think the important thing is that don't go and get into trading. Be an investor. Think long term, be patient, and use SIP as a route. Why? Because SIP creates a good accumulation, and it also contains the fluctuation of markets. Sometimes markets go up, sometimes markets go down. I think that all is also getting covered by it. And the last thing is that a lot of investors we have seen books their profit first and always keep with their loss-making portfolio.
Because that's the thing, and I want to ask you this because I think this is a wider question. We get it from a lot of our viewers. That when do you know if you have a bunch of mutual funds and there's one that's underperforming? Sometimes they say that don't exit too early, and just when you exit, it'll start performing well, that fund. And sometimes you'll keep sitting on it, and it'll be this underdog in the portfolio, which always causes pain. So when do you know when to get out? So
I would say there is no clear answer to it, but I would say that if you have 5 mutual funds in the same category, like A, B, C, D, E, F, Y, and you find the median is, suppose I believe 15%. And if one of the fund is doing 7-8% only, when this fund is consistently not performing for the second year, then it's good time to exit. You can't keep hanging on to your unperforming investments because that can become a big drag. When we were talking about compounding and the rate, I think these drags also should need to be removed at the right time.
Wait for a year. If there's still no turnaround, if it's still really underperforming its peer set, then maybe it's time to rethink that particular fund. Got that? Okay, Rahul, so we're coming to the end of the conversation. It's been a very fruitful one. We have a concept of a money minute. So you can either encapsulate all this into a minute or anything else, but basically your money minute, your money mantra for all the viewers out there, what would it be?
So I would say for all the young adults, start early. I think compounding can be massive. In 30 years, you can make your money 100x. So start early. Second is always use asset allocation. I think it's a good risk diversification model. Third, use the SIP route. I think that will help you accumulate money over a period of time and not create discomfort in your financial planning. And fourth, and the most important, be patient and be long term.
Okay, all right. I think those are the 4 key pillars on which great riches and great wealth can be created. And it's important to keep them in mind. I think that was a very, very helpful session, Rahul. Thank you for joining in. Simple, straightforward. And really appreciate you being with us. Hopefully, we'll have you back on the show answering more of our viewers.
Sure, looking forward to it.
Okay. All right. Well, folks, with that, it's a wrap on this edition of Let's Talk Money. Hope you found the conversation fruitful. Remember, this is your show. Whatever you ask, we answer. So keep sending those queries on our social media handles, or you can email us on askcnbctv18@nw18.com. See you again on the show next week.
Let's Talk Money